Well, I think when you have two sides of the equation where you have those people who are cautious because of the percentage of companies that are trading above their 200-day moving average, or you find that investors are worried because of seasonality, yet you have on the other side, as you mentioned, those that point to the amount of money that is trading on the sidelines. Certainly, that's what makes a market. I think that the market is possibly due for some sort of a digestion of recent gains, meaning a pullback of 5 to 10%, or maybe even slightly more. But I believe that the breadth of the market, the participation of so many stocks, so many sub-industries in the S&P 500 is an indication that we are not near a new bear market, but are simply possibly near a traditional set of volatility. With the market moving up so rapidly, I wouldn't really say that investors are being prudent. I think that they are experiencing FOMO, fear of missing out. And so in some ways are just throwing money at stocks. Right now, the low quality index is outperforming the high quality index. So, investors are just buying whatever happens to be going up, not necessarily what is of fundamental value. So I think that that is an indication that maybe we are getting near to some sort of inflection point in the market that could indicate that at least some disappointment is at hand. So right now, margin debt is at an all-time high. And so with so many people who have borrowed money in order to purchase equities, we could get a cascading effect of margin calls. So instead of maybe a pullback, we end up with a mild correction. But right now, I don't really think that we are setting ourselves up for a bear market, primarily because earnings growth has been improving. At the beginning of the first quarter, expectations were for a 14.8% year-on-year gain. Now we're looking at a 19.7% year-on-year advance. So earnings are improving dramatically for a quarter that has already passed and is improving for the guidance for coming quarters. Well, I think that we had a pretty easy comparison for the first quarter of this year, and that's why we're now up almost 20%. But I think that the comparison will be even easier for the second quarter because that's really when earnings growth and economic growth tanked so dramatically. So that's why we're now looking at a near 52% year-on-year gain in S&P 500 earnings. The real question is by how much will the remaining quarters advance and by how much will the 2022 earnings estimates be ratcheted higher? Because right now the S&P is trading at a more than 40% premium to its long-term PE ratio on coming 12-month earnings. So that is a concern. Yet it becomes less and less of a concern as forward estimates continue to rise. So if we see a strengthening in guidance and an improvement in forward estimates, then I think that whittles down the premium and will allow investors to breathe a sigh of relief. Right now, S&P Capital IQ consensus estimates point to a near 16% year-on-year gain in 2022 earnings for the S&P 500, which is almost twice the average gain in earnings going back in time. So I would tend to say that estimates are still optimistic for the year after this one. So I don't think we're going to start hitting very tough comparisons until we get into the latter phases of 2022 and even into 2023, especially if expectations rise for the Fed to start to raise interest rates.